Hi. Well, I'm Ty and I'm here in my garden, and today I wanted to talk to you. I have another video for you to talk about how making loans to your S corporation can improve the taxes or the tax position for the shareholders. And so just as backgrounds, S corporation owners will often loan money to their S corporations to help finance growth or keep things afloat during hard times. Loaning funds to the S Corp is often easier or more flexible than them actually making a capital contribution in exchange for stock. This is especially true if the capital infusion is only intended to be short-term. It's easier to put money in and then take it back out without complicating the distribution accounting. You don't want a corporate equity distribution or dividend just because you're pulling out the extra cash no longer needed for the company, right? So S corporations are treated as flow-through entities where the income of the business is ultimately taxed on the owner's tax returns. When an S corporation has losses instead of income, those losses could be deductible on an owner's tax return against income they have from other sources. There are limits to an owner's ability to deduct these losses, the first of which is the owner's basis in their S Corp. Losses and deductions reduce basis, while income will increase basis. And an important rule to know is that basis can never be less than zero. So if the S corporation flows through more losses and deductions than the owner's basis in the S corporation, those excess losses end up being suspended until basis is restored with additional capital contributions or positive income. Other limits that I'm not discussing in this video on whether you can deduct losses would include whether the S corporation is considered passive activity and the character of the losses actually being flowed through to the individual shareholders. An S corporation owner has basis in their equity ownership of the business, and that's often referred to as their stock basis. The term stock basis hails back to the origins of the S Corp structure because it used to primarily be an alternative to the C Corp structure for what I would call a true corporation under state law. But as of today, many S corporations are actually LLCs, limited liability companies under state law. So the term stock basis became more of a general reference to the owner's basis in equity. Here's a quick example. Suppose two owners contribute $1,000 each to the formation of their S Corp. Each owns 50% of the S Corp and each has $1,000 in stock basis. The S Corp then obtains a loan for $500. The S Corp sustains losses of $2,400. Each owner has $1,000 of losses, which flow through to be considered on their personal tax returns. The owners reduce their stock basis each to zero. Each owner has a $200 suspended loss then that gets carried forward. Well, Congress must have foreseen the use of owner loans as short-term capital infusions because the tax law provides that an S Corp can claim tax basis. An S Corp owner, I should say, a shareholder, can claim tax basis in the S Corp for the purpose of deducting losses basis in their debt. The owners will not only receive such debt basis for amounts they personally loan to the company, but longstanding practice, which has been codified in the regulations, clarify that an owner's guarantee of corporate debt is not enough to create this debt basis. So it has to be a direct loan from the owner to the corporation. So in the above example, if the $500 loan was made from one of the owners and was a bona fide note payable, and that owner can flow through, then that owner would be able to flow through an additional $200 loss against their debt basis, and that would reduce their debt basis now to $300. The owner is now able to consider $1,200 of losses on their personal tax return and has no suspended loss carry forward. The other owner who did not loan any money to the S Corp is still limited to their $1,000 loss and continues to carry forward a $200 suspended loss. An S corporation owner's basis in debt allows them to flow through more losses and deductions for consideration on their personal return. In a future video, I hope that I'll have some opportunity to address making sure how the owner's loan is a bona fide debt. There is what's called the safe harbor debt under the S Corp rules, which I already have a video out on. So take a look at that. And what does it mean to have a bona fide debt in accordance with tax regulations is an important topic. And you want to avoid the risk of having improperly structured or managed loans. Okay, well, that's it. The importance or the benefit of being able to establish debt basis for your S Corp. I'm going to get back to gardening. If you enjoy these videos, if you find them helpful, please subscribe and let your colleagues and friends know about it. Get them to watch as well. And I'll keep doing this. All right, I'll see you all later. Take care.